Hey guys, Joel Frank here, market analyst for YouTrading, and today we're taking a quick look at the S&P 500, which is pretty much the index, the equity index of the top 500 stocks in the US. Let's take a look at the chart. I mean, I've got a couple of interesting things I want to point out really. So as you can see here, I've got the USA 500, S&P 500. I've got it on 4-hour candlesticks, and what I'd like to do is just zoom out and talk about what's been going on in the last, well, since the start of the year really. Since the start of the year, we've seen time and time again these little pullbacks, each of them, 3 to 6%, and every single time we've pulled back and gone under the 21 DMA, which is in orange, and the 50 DMA, which is in green. People have bought the dip. Equity investors have aggressively bought the dip. It's happened 1, 2, 3, 4, 5, and now it seems as though we're in the process of it happening for the 6th time. But each of the previous 5 times this has happened, every time we've dipped under the 50 DMA, we've then recovered back to record highs. Dip below the 50 DMA, back to record highs, below the 50 DMA, back to record highs. So you can see why when we dipped very, very briefly below the 50 DMA earlier in the week, equity investors were just all over it. They've seen this pattern happen time and time again. I mean, you have to go all the way back to this period that I've highlighted here. This is sort of September to the start of November last year. That is the last time we've had a dip from a recent high back to under the 50 DMA and then not recovered back to further record highs before then dipping below the 50 DMA again. So pretty much every time since then, it's been higher lows and higher highs. So yeah, I mean, to be honest, things are still looking bullish for stocks. In terms of the fundamentals, what's going on, let's zoom in a little bit. Let me get my arrows out as well. You can see we did have this pullback sort of from last week into earlier on this week. What were traders citing for this? Well, obviously we've talked about this in the daily market briefs. We have seen a bit of a period of risk off in markets, particularly on Monday and then again on Tuesday, particularly more in FX markets. Traders talking about a resurgence in coronavirus pandemic fears, pretty much. The Delta variant, the spread of it is accelerating pretty much across the entire world, especially in places like the US and Europe and the UK, despite the fact that vaccine coverage is pretty high. However, it seems as though in the places where vaccine coverage is good and the vaccine rollouts have gone well, the previous link between high infections and then a very high death rate has gone. So fingers crossed, in places like the UK and the US and Europe, where the vaccine has been rolled out to vulnerable people and most people now, this rise in infections isn't going to result in a rise in deaths that's anywhere near as bad as what we've seen in the past. However, unfortunately for the rest of the world, where the vaccines are yet to be rolled out, well, they've got to deal with it all over again, more lockdowns, and all that kind of stuff. But yeah, in the US, UK, Europe, a lot of these developed countries where they have rolled out the vaccines, it seems unlikely that there's going to be a return to the strict lockdowns that we saw earlier on in the year before widespread vaccine coverage and back in 2020. And that, for me, is definitely one of the reasons, the fact that we do have widespread vaccine coverage in places like the US, and this is obviously a US equity index. That is one reason why equity investors have been motivated to buy this dip. They've thought, okay, the Delta variant, we are seeing another wave. It's not going to be good, of course, but at least we're probably not going to have a return to strict lockdowns. And then more broadly, you've got other factors like, if you look at bond markets, long-term bond yields are very, very low. Inflation expectations aren't particularly elevated. And all of that sort of points to the fact that markets expect that, number one, inflation is not going to be too bad over the next 10 years. We're not going to move towards like hyperinflation, as some fearmongers suggest. And also, central bank policy, particularly from the world's most important central bank, the Fed. That's obviously the most relevant central bank to this US equity index. The Fed is likely to maintain accommodative monetary policy. Even if it does do a few hikes over the next couple of years, it's still going to be very, very accommodative by historical standards. That's why bond yields are so low by historical standards. And obviously with bond yields low, well, why would you invest in bonds? If the yields are so low, put your money in equities. So all of these long-term factors, you know, the fact that we've got vaccines, that we've got accommodative central banks, that bond yields are low, they seem to be keeping this this underpinning in equity sentiment for the US index for now anyway. So if things really do start to sour, how are we going to know? How are we going to know when to not buy the dip? Well, I think, like I said, let's zoom out a bit. Every time we get to this 50 DMA, it seems people jump in. So if you really want to know when equity investor sentiment has really go into the south, that's when you want to look out for a big break below the 50 DMA, and I'm talking like a decent break below it, like 5% below it, and then potentially a test of this 200-day moving average. I don't think that's going to happen though, personally, but we'll have to see. I personally predict we're going to be going back towards record highs in fairly short order. Might take a couple of weeks to grind back up there, but yeah, I think this upwards trajectory that we've been seeing over the last few months is set to continue. But anyway, hope you enjoyed the video, guys, and I will see you all in the next one.